Before starting the video, click the subscribe button and turn on the notification bell. Hello and welcome to House of Commerce. Hope you all are doing well. So today's lecture is about inventory valuation, and in this lecture we are going to discuss about cost and net realizable value, how to calculate the valuation of inventory, and the journal entries under both of the systems. So let us take a look. Stay tuned till the end of lecture. So we have discussed before that what inventories are. Inventory is the main business of the company, which the company does in ordinary course of business. And according to accounting, inventories are number one, held for sale in ordinary course of business. What this term means? It means that inventories are those assets of an entity which are held for sale in normal course of business. Means if the company is having any asset and it is likely to sell that, so that does not mean that it is an inventory. It should be the main business of the company, then it will qualify as an inventory. Then on number second, in process of production for such sale, means it is the main business of the company, but it is in the process of production till now. So when it will be produced, it will be sold as a main business. That is why work in process or the production in process is also the part of inventory. Then in the form of material or supplies to be consumed in the production process or in the rendering of services, the raw material used for the production of goods are also classified as inventories. So all these are inventories, means the raw material which is to be produced as a final good, then the material which is in process of production, that is also an inventory, and the finished goods, the material which has been converted into the final goods, that are inventories for the companies as well. So this is what inventories are in the view of accounting. Valuation of inventory. Accounting says that inventory should be carried at lower of cost or the net realizable value, which we call NRV as well. Now we all know about what is cost, but we do not know about NRV, the net realizable value. So how to calculate the net realizable value? Let's take a look. Net realizable value is the expected selling price in the ordinary course of business minus any cost of completion, disposal, and transportation. Confused? So let's take an example. Let's assume that a company cost of its inventory is 55,000 rupees. However, at the end of the accounting year, the company can sell the inventory for only 50,000, provided that the company spends an additional 5,000 of packaging and shipping expense. So we have discussed before that NRV, net realizable value, means selling price minus cost to sell. So the selling price is 50,000 and the cost to sell is 5,000. Therefore, the company will deduct 50,000 minus 5,000. So the net realizable value shall be 45,000. And the accounting valuation says the inventory shall be carried at lower of cost or NRV. Now here the cost is 55,000 and NRV is 45,000. So we shall carry it lower of cost or NRV. So it shall be carried at NRV 45,000. Now let us take another example of different items to carry the inventory at lower of cost or NRV. So here we have item A1. which has a cost of 8,000, selling price of 7,800, and cost to sell is 500. So we shall carry it either on 8,000 or 7,800 minus 500, whichever is lower. So here 7,800 minus 500, 7,300 is lower, so we shall carry the amount of inventory at 7,300. In the next item, A2, cost is 14,000, selling price is 18,000, and cost to sell is 200. So 14,000 or 18,000 minus 200, whichever is lower. So 14,000 is lower of all, so we shall carry the inventory, the item A2, at 14,000, lower of cost or NRV, and then in the next steps we shall do the same. Hope you have got the clear idea that what NRV is. Inventory is divided into two systems: perpetual inventory system and periodic inventory system. Now what are that? Perpetual inventory system means where all the transactions are recorded on their respective date separately, and periodic system means where the transactions of sale and purchase are recorded collectively, means the purchases of whole year are recorded collectively and the sales are recorded collectively, accumulatively. So the total sales shall be recorded for the whole period and the total purchases shall be recorded for the whole period. They shall not be recorded on their respective date, but they shall be combined to record the cost of sale or to calculate the gross profit and all that. So let us take a look about the entries under both of these systems. So first of all, opening inventory. In periodic inventory system, the opening inventory shall be the last year's ending inventory balance. Here, in perpetual inventory method, the closing inventory shall be the closing balance of the inventory account in the previous period. Then, while recording the purchase entry under periodic inventory method, you will record the same as you record in the normal journal, that purchases shall be debit and payables or cash, whatsoever the terms of purchases were, you will credit the same. Then, under perpetual inventory method, inventory shall be debited instead of purchases and cash or payable shall be credited. Then, freight or transportation paid. So carriage inwards debit and payable or cash credit. Then afterwards, this carriage inward shall be added into the purchases. That is another thing. But under these systems, we have to see. Then carriage paid under perpetual inventory method shall debit the inventory account. It shall directly go to the inventory account and payables or cash shall be credited. Then return of inventory to the supplier. We shall pass the same entry as we pass in journal, that payables debit and purchase return credit under periodic inventory method. But under perpetual inventory method, you'll debit the payables and credit the inventory account. Then the entry which has to be understand is sale of inventory. Now under periodic inventory system, you'll pass only one entry, receivables debit and sales credit, like you do always. Then under perpetual inventory system, you'll pass two entries. One is the normal one of sales, receivable debit and sales credit, and you have to pass the other entry as well. On the same date, you pass the entry of sales. So what will it be? Cost of goods sold debit and inventory credit, because these inventories have been sold and they have to be transferred into the cost of goods sold account, and cost of goods sold account is an expense account. Therefore, the increase in cost of goods sold shall be debited and inventory is being reduced as it is being transferred to the cost of goods sold account. Therefore, inventory shall be credited. Then, if the customer returns the goods, return of goods by a customer under perpetual inventory system, you'll pass the entry sale return debit, receivables credit, and you'll pass the next entry as well, inventory debit and cost of goods sold credit. But under periodic inventory system, you'll pass only one entry, sale return debit and receivables credit, like you always do. Then, in case of normal loss, there will be no entry under periodic inventory system. But under perpetual inventory system, you will have to pass the entry and you will have to increase the cost of goods sold because the inventory has been transferred, or the normal loss is transferred as an inventory to the cost of goods sold. Therefore, cost of goods sold debit and inventory credit. Then, in case of abnormal loss, you will have to decline the inventory in whatsoever the method is. Either it is periodic inventory system or perpetual inventory system. Both of the systems shall record the abnormal loss from the account of inventory. So under periodic inventory system, abnormal loss debit and purchases credit. And under perpetual inventory system, abnormal loss debit and inventory credit. Then closing inventory. Closing inventory entry shall be passed and shall be calculated as inventory debit and cost of sales credit. Then under a perpetual inventory system, the balance of the inventory account shall be treated as closing inventory. Now let us take a look at how to calculate the cost of inventory. It is divided into three different classes: first in, first out, weighted average, and last in, first out. So first in, first out means the product which is sold first shall be sold first. So you will have the sequence according to the date that which inventory was purchased at first and which was purchased at last. So the first purchase inventory shall be sold first. So this is called FIFO method. Then weighted average. Weighted average means that all the inventory purchased shall be carried at one single average cost. And then you will have to calculate the cost of inventory according to an average cost. Then last in, first out. The product which is purchased at last shall be sold first. So LIFO is not permitted by IFRS anymore. Why it is so? Because it is obvious that the last purchase inventory shall have the higher cost than the first ones. Therefore, it shall impact the profit in that sense. That is why LIFO is not more permitted by IFRS. So let us take a look on the example question that how to make a chart of inventory under FIFO method. So suppose the company has the opening balance of 10 units purchased at $250 and the total cost is $2,500. Now this shall be written into the column of balance. Now do remember one thing, that this balance column is supposed to be the go down or warehouse of the company, of the company's chart. So this 10 shall be put into this column. Then in week 2 the company purchased 15 units at $230 and the value is $3,450. So the same shall be written in the balance column in the same sequence that the inventory which was purchased first, it will be written on the first, and then the which is purchased at second, it shall be written at second. Then the cost shall be same on which it was purchased. Then the company has got the contract of selling 15 units. Now it shall take this 10 into 250, and the balance of 5 shall be taken from these 15 into 230. So we'll take 5 into 230. Then now the company's 10 units has been sold, and 5 out of this 15 have been sold. Now the company has a balance of 10 units only at the cost of 230, and the total cost is 2,300. Now at week 3, the company purchased 20 units at 235, and the total value is 4,700. Now the sequence shall be the same. Which was at first shall be written at first, and which came at second shall be written on the second number. So this 10 will be written first, and then this 20 shall be written on the second. Now the company has got the contract of selling 20 units. So we'll write in the same sequence that this was first, so this will be written on first, and this was second. So out of this 10 units will be sold and shall be written on the second number. Now there is a question which will arise, that why we are writing this cost in the column of sale. So do remember one thing, that this is not actually the column of sales. This column is just to calculate the cost of sales. So this all is cost. Therefore, it shall be written here as a cost, not the selling price. Now let us take a look on weighted average method. So weighted average method shall be calculated on average cost. The inventory shall be kept at average cost. First of all, let us see that on 1st February, the company has 1200 units at 2 rupees, and the total cost shall be $2,400. Now this inventory shall be kept at balance. Then on 4th February, 600 units are purchased at $2.10, and the total cost shall be $1,260. Now the total cost is 2,400 plus 1,260, 3,660, and total units are 1,200 plus 600, 1,800. Now you have to keep all these units at an average cost. So how will you keep it? This 3,660 shall be divided by total units, total cost divided by total units, and you'll get the average price per unit of 2.0333. Now if you have any of the sale of units, you shall sell it at an average cost. How? For example, you have got a sale contract of 1,000 units. So you won't sell it at 2, you won't sell it at 2.10, you shall sell it at 2.0333. Then the company will have the balance of 800 after the sale of 1,000 units. Out of 1,800, it will have the balance of 800, which shall be kept on the same average cost of 2.0333. Now again the company purchased 400 units at 2.2, and the cost is 3,080. Now the total units are 800 plus 1,400, 2,200. and the total cost is 1626.67 plus 3080 4706. Now the total cost divided by total units shall give us an average cost. Then if the company again gets a sale contract, it shall sell it to the new average cost. Now we have 1600 to sell, and it shall be sold at the new average cost of 2.1394, and the amount shall be 1600 into 2.1394, 3423.03. Now the company has leftover balance 2200 minus 600 sold equal to 600, and this shall be kept again at this average cost. Now the company has purchased 600 more units at 2.5, and the total cost is 1500. So the company has total units of 600 plus 600, 1200, and the total cost 1500 plus this 1283. So the total cost is 2783, and this shall be kept at average cost, which shall be recorded as 2783 divided by 1200, 2.3197. Then the company has got another sale contract of selling 200 units. So this shall be sold at a new average cost of 2.3197. So the company will have leftover balance 1200 minus 200 sold equal to 1000, and this shall be kept at the average cost, and this shall be cost of ending inventory. So that was all for today's lecture. If you have any query, you can put into the comment section, and we will make its part 2 as well, where we will solve the questions. Till then, good luck.